Hello, everybody, and welcome to Finance Magnates webinar today. My name is Celeste. I'm an FX editor here at Finance Magnates, and I'm really excited to be hosting this webinar, which is called Emerging Market Currencies. Can they be the saving grace of FX? Today, I'm here with three industry experts with extensive knowledge of the FX industry. And our speakers are Haralambos Besouros, who's the Senior Market Analyst at JFD Group, Stephen Innes, Chief Global Market Strategist at Axicorp, and Alastair Schultz, the Chief Market Analyst at ACY Securities. So 2020 has been particularly good for the foreign exchange industry, with COVID-19 bringing heightened volatility. And as a result, we have seen a wave of new traders and also dormant traders coming back to the markets. And this has been really great for brokers and has resulted in an overall uptick in trading volumes and trading activity. However, as volatility tapers off for the major currency pairs, a question has come to light, which can emerging market currencies keep traders interested in FX trading for longer, as they tend to have higher volatility than the major currency pairs. So this, along with a suite of other topics, will be discussed today during our panel. So after our discussion, the floor will be opened up for questions. And we'd really love to hear from our audience today during today's presentation. So if you have a question for our speakers at any time, please feel free to leave us a comment and we will answer them at the end. And if we don't get to your question during this panel, then we'll be sure to follow up afterwards. So before we jump into the discussion, I would really like to let our speakers introduce themselves quickly. So Haralambos, can you please give us a quick insight and intro to yourself?
Okay, hello all, my name is Haralambos Besouros. I am a senior market analyst here at JFD Group. I'm in the market analysis field since 2013 when I started my career as a technical analyst. I'm a certified financial technician as well as a member of the Society of Technical Analysts and a member of the SciSec Public Register. I'm a holder of a bachelor's degree in mathematics and a master's degrees in actuarial and financial mathematics from the Aegean University of Greece.
Perfect. And Stephen?
I just started as a global market strategist in the last couple of years. Joined Axicorp in the last 12 months. Prior to that, I was running a EFX trading desk for 15 years. And prior to that, I was a proprietary trader, G10 currencies and emerging market currencies for a large Citibank. I've been in the foreign exchange markets effectively close to 25 years.
Wow. And Alastair, last but not least?
My name is Alastair Schultz, and I am the Chief Market Analyst for ACY Securities. At ACY, my role is to help our clientele and many others understand the key metrics that are involved with financial markets, regardless of their experience levels. I started my career on the floors of New York about 15 years ago today, and I'm fully immersed myself on the very early onset in financial markets. And having lived and breathed the markets for this much time has resulted in me writing my own book, and my personal claim to fame is that I'm now Tim Cahill's personal trading coach.
Oh, well, that is a nice claim to fame. How is he picking up?
He's doing quite well, actually. Obviously, being a competitive football player for a number of years, you do sometimes have to relate the idea of what we talk about on financial markets towards, how you can achieve it through soccer or football, as he likes to call it. But it is a different experience, but it is a lot of fun, and he's enjoying it a lot, and I am too.
Haralambos, I don't know if you know, but Tim Cahill is Australia's soccer star, football star, as the Europeans call it. So yeah. Anyway, so enough about Tim. Let's get into the discussion. So with the emerging market currencies, obviously. They can be quite loosely defined. So before we jump in, for the benefit of our audience, Alastair, can you take us through firstly, what is an emerging market currency?
Absolutely. So there's a couple of different characteristics towards an emerging market, but also naturally the currency that comes derived from it. Generally, it's a country that's in the process of economic advancement. Typically, you would experience a period of robust growth in the industrial production sectors, and then that would lead to the expansion into the economy as a whole. the growth sort of acts as a catalyst for them, and it usually helps with further developed on their infrastructure and technology sides down the track. And then usually substantial foreign investment sort of gets attracted to them because you get this high return probability. There's not truly a concrete definition for an emerging market that exists currently, and it is largely debatable. But generally, they will exhibit increased volatility by comparison to the major pairs or your commonly traded currencies. They often have underdeveloped infrastructure. When I say that, I mean roads, buildings, schools, and general infrastructure that still needs to be developed. And so that generally means that these economies require a lot more investment, but do have a higher potential growth rates. And this comes with higher debt levels, which by an investment standard and uses the general rule of higher risk, higher reward. They often also have a very young population, and with the pyramid being sort of bottom heavy, most of the time we'd think of an aging population and you'd be pyramid at the top, and then it's the opposite. It's the total opposite for that, and that sort of comes with the underdeveloped infrastructure. They almost always have high levels of debt, and emerging markets tend to rely heavily on foreign borrowing to really have their funds of investment. And this is partly the reason that emerging markets are incredibly volatile. If investors lose confidence or back out, it can lead to large devaluations of the local currency as investors tend to bail.
And as you just said there, emerging market currencies do tend to be much more volatile than the major currencies, and obviously their economies aren't as stable, obviously, as some larger countries. So with the coronavirus pandemic, obviously it's posed many challenges across the world, but it has put a lot more pressure on many emerging market countries. So Haralambos, which emerging market currencies have particularly struggled so far during the pandemic?
I would say that all the economies have felt the heat of the coronavirus spreading, as the lockdown measures adopted worldwide have resulted in strong damages to the global economy. We have the IMF now expecting the 2020 output to shrink by 4.9%. Advanced economies as a whole are forecast to tumble 8%. And although emerging markets are expected to contract only 3%, we have some economies that stand out, like Brazil, Mexico, South Africa, and Russia, which are forecast to tumble 9.1%, 10.5%, 8%, and 6.6% respectively. On top of that, Brazil, Russia, Mexico, India, Peru, and Chile are among the top 10 nations on the board with the most infected cases from the coronavirus worldwide, with Turkey and South Africa taking the 14th and 16th places respectively. So we have several emerging markets on the top of that board, which is worrisome with regards to their respective economies.
Definitely. And Stephen, your kind of area is more in the Asia markets. What's the situation currently in Asia?
Too bad. It's we're starting to see what we refer to as the corona divergence trade emerging. The thought is that Asia currencies and Asia countries actually contain the virus a lot better than developed markets and some of the other emerging market currencies. And this is playing out quite favorably. But really what the key is here is about the low interest rate volatility from the US and the low volatility on US equity markets. It's allowing investors that reach for yield, and what we're seeing is a reach for currency carry throughout Asia, whether that's the Indian rupee, whether that's the Indonesian rupiah, even the Malaysian ringgit, and even the Philippine peso are benefiting from that reach for yield. And that seems to be the sentiment with volatility and interest rates quite low and volatility in stock markets quite low. Investors are opening up their horizons.
So overall, it's been quite positive for the Asian region.
Very much so. Just looking today, for instance, on a liquidity push from the PBOC, we've seen a big dive into Asian equity markets, particularly China, and that's also driven quite a bit of currency flow. We've seen the Chinese yuan trade below, or the CNH, the offshore yuan trade below 705 today. That's really predicated on international flows coming in, and this is quite favorable. This dates back to just the April, so we've made up quite a lot of distance from the initial meltdown, and this is playing out quite favorable. Hey, despite the amount of risks that are going on between the U.S.-China trade war, and and this is also taken into the recent U.S.-Hong Kong fracas. So there's a lot of issues beyond the COVID weighing on Asia's sentiment right now. So things are trading quite favorably, in my view.
Well, that's obviously that's good to hear. But as Haralambos kind of mentioned earlier, it's kind of not going favorably for all regions across the world. And there's there's the three countries that are leading in terms of COVID-19 cases, and that's of course the United States is taking first place, and then behind it is Brazil and Russia. And so Russia and Brazil are two emerging markets. So I'd really like to just look into both of those for a little bit. So Haralambos, how has the Russian ruble been faring during this whole pandemic so far?
The Russian ruble suffered from the beginning of the year until the 15th of March, falling approximately 22% against the US dollar. We saw a decent, let's say, tumble of the ruble against the dollar, but from there onwards, we saw a decent recovery of around 12.5%, one of the most decent recoveries in the emerging market world, alongside the Indonesian rupiah. This may have been, in my opinion, due to the latest recovery in oil prices. So we had the tumble in oil prices and the Russian ruble followed through. Let's not forget that Russia is one of the world's largest oil producers, and its economy is linked to oil prices, and thereby the Russian ruble is sensitive to oil prices. So the tumble in oil prices dragged the ruble down, and then when we had the recovery in oil prices, when things appear to be better and we had signs of the global economy rebounding at a, let's say, better pace than previously thought, we saw the oil prices rebounding, and we saw the Russian ruble staging and decent recovery as well of around 12.5%. Another point I would like that may have helped the Russian ruble is that Russian real interest rates are still positive despite the nation's central bank cutting nominal rates by 100 basis points at its latest meeting on June the 18th.
All right, so basically we've seen a recovery in the Russian ruble. Alistair, do you think that in the short term that's going to continue?
Yeah, I think there's a few different things to sort of consider when it comes to the Russian ruble. Over the short term specifically, there's a number of factors that are sort of influencing where it might go in the near future. Firstly, from the political side, it's likely to be relatively stable. Putin has successfully extended his time frame over which he can, hold power for, which is until about 2036 now, it seems. And it is possible for that end date to, for him being current president for a much longer period of time. The one thing to keep in mind, though, is that he is sort of aging on and he's getting a bit older, and he may decide. So he's only got 2 terms really here to play with. Each term is 6 years. So that is certainly something to keep in mind. If he is to stay in power for that time, the entire time he has been, it's been a relatively stable political field. From that side, you've also got the international relations and that sort of perspective to consider. They have had issues for decades, but their largest trading partners have remained consistent with them, being parts of the EU, China, Japan, and obviously Germany as well. And having said all that, though, 48% of their exports are actually derived from oil, fuels, distillates. And so, we have to put into consideration of these short-term valuations, just as Haramba says before, to be considered on the oil side of things. So for me, the price of oil and the ruble have a very close correlation. You could even say it's an over-dependence when it comes to the Russian sort of how dependent they really are on oil pricing. So after, the strong recovery price that they've had in the oil crash and over the March to May period, Brent and WTI have been sort of struggling really to push past that sort of $40 and $43 barrier respectively. And coincidentally, that's actually the lows of what we saw during the GFC crash of all. And considering that side of things, we've also got the resurgence of COVID-19 going across the globe. And that has certainly wobbled those values just a little bit. The worries over travel are certainly bringing down that idea. And so it's really looking at whether there's going to be constant demand on oil, which will naturally push on the side of Russia and the Russian ruble's value. So whilst they've been maintaining their cut agreement, which is about $9.6 9.6 million barrels per day that they're sort of pushing towards, and they've been sticking really close to that. It doesn't take much for an OPEC agreement to sort of fall back on. So at the moment, the very first things I'm going to be looking for this month when it comes in mind to A, oil prices, but also B, where the Russian ruble goes, is what we're going to see from OPEC later this month. In July happens to be that point where they're actually looking at, either extending cuts, putting in bigger cuts, or perhaps reducing the cuts. So it'll be interesting to see where it lands at the end of this month. And I think that'll really determine where it'll go. In my own opinion, though, I feel that we will probably see a reduction in demand for oil, especially with the second wave, I suppose you would call it now, and therefore likely a lower price for both oil and the ruble.
All right, and you said it there, the second wave of coronavirus, which I guess now we've had the first wave, everyone's talking about the second wave. Just as an open question to you all, do you think we will have a second wave, or it's just the first wave hasn't even finished yet? Stephen, you're shaking your head. So what are your thoughts on that?
Yeah, I'm a little bit, reticent of the second wave argument. Really, I think we're seeing some huge pockets in the Sun Belt states that have popped up here, and this is basically because they haven't adhered to social distancing. The U.S. will be very, very slow to lift off. If we look at how the virus is actually being contained throughout most of the world that have practiced social distancing, using China as an example, billions of people, right? And it's been very effective. I think what we're seeing here now is Texas moving to enforce masks. I think people are realizing that they have to wash their hands at minimum and then stay apart. So we have to be very careful how we're interpreting the epi curve globally, whether we're actually coming to a second wave, because it's not necessarily the government mandated lockdowns that are really driving the sentiment lower. It's the fear index, really. It's what people aren't coming out and shopping or driving or using their cars. This is the problem. I don't want people to get overly fearful that they can't leave their house if they don't protect themselves. And this is the biggest thing that we have to be careful of. That's my view on the second wave rhetoric.
I'm also inclined to agree with Stephen on that sort of front. I mean, where has really a second wave begun and ended, whereas the first wave started and begun? So that sort of does bring a little bit of risk, I suppose, for an investor side of things, is that it's been an ongoing thing for 6 or 7 months now, and there's not been really an area that you can pinpoint and say, this is where it begins, this is where it ends. Yes, we have other clusters that have come up. So to me, I think it's just an ongoing scenario. It doesn't mean that you're not going to ever get a point that says this is a second wave. So unfortunately, I think that's just the way it's going to be for some time to come, regardless of what country it is. And even if you look at our own instance here in Australia, where we are getting those new clusters of infections down in Victoria, that's been something that's started very small, picked up quite rapidly, but Australia's been able to maintain and control that quite quickly. It's more concerning actually about earnings season than it is about the idea of the virus and where it's going to go from now.
I think the outbreak of coronavirus, like small pockets, is unavoidable. It's going to happen. We have to be prepared for it. You just got to wear a mask, right? So I mean, it's not going to. We have to look at it in terms: is it going to be as significantly negatively impactful as what the first wave was, or where we were in March? I think people have realized. I think consumers are very, very smart, and I think a lot of concerns the media doesn't appreciate that fact that people will adhere to social distancing and the curve will flatten at some point. I don't think we're going to keep at these elevated levels in the Sun Belt for the next 2 or 3 months. So, that's one thing we have to keep on the risk horizon.
Yeah, I have to agree. That it's not a matter of saying that it's a second wave or the first wave continuing, and what could be a catalyst for the future performance of the market is not the infections per se, is whether we will have another round of lockdown measures. Most economies around the globe are easing their lockdown measures, and this is helping the economies to perform fairly, let's say somewhat better than previously. We have even the US economy shows data coming out of the US are showing that the economy is doing better than previously thought. but the US is the number one on the board with regards to infections. So it's not whether we have a first or second wave, or whether we have infections accelerating, is whether this will lead to another round of lockdown measures. If we have another round of lockdown measures, yes, the global economy will take a second hit, and yes, we are likely to see another round of risk aversion. Now, the question here is whether this round will match the previous one, and whether the previous one has priced in the damages throughout the whole of the year. So it remains to be seen, in my opinion.
I can't see how governments will go down that road again, given the economic cost they've gone through. I mean, it was just cataclysmic. I mean, there's absolutely no way they're going to lock down the economies again to any degree. I think we'll see soft lockdowns, and I think that's about as far as we're going to go. You know, they're going to limit huge gatherings, but gee, you know, we can't go down that path again. We can't have another, you know, and see another, you know, 40 or 50 billion worth of GDP go up in flames. That just can't happen.
No, I have to agree. I don't see them actually being able to even afford the idea of a second full-scale lockdown. And I mean, this second sort of lockdown things that we're experiencing here in Australia is simply, you know, you lock down a few suburbs or where you've got the cluster of infections, and you make it really, really strict, like you can't leave your house sort of thing. So that's the next sort of wave that I think that we are going to have in terms of lockdowns occurring. But that doesn't mean we're going to see full states or full countries shut down permanently. And of course, I mean, I suppose the one, you know, benefit of the first lockdown is that a lot of businesses have worked out that, you know, they can actually have workers from home, and that their efficiency levels actually increase. So, you know, there's certainly a number of larger entities that are now considering this whole work from home as to be the new norm, regardless of whether COVID is here or not. So I think that's probably a good thing for some people, not so good for others, but, you know, whatever floats your boat in that instance, I think.
Definitely. I think, you know, for all the negative impacts that COVID has had, I think we should also see some positive impacts. And as you said, whether that's flexibility from with working from home. But actually earlier today, I saw that apparently in Mongolia, they've got cases of the Black Death there. So, you know, it's a good
bubonic
2020.
plague.
Yeah, 2020 has been a good year, and I think we'll still be having some volatility, at least for the foreseeable future. And so the other country that I did want to talk about as well was Brazil. You know, at the time of recording, they're currently in second place in terms of COVID-19 cases, only behind the US. And obviously this has put a strain on the country's economy, particularly because tourism is such a big part of that. And obviously not to mention the job losses and business failures. So Stephen, what have you noticed with with Brazil's currency amid all of this?
I think it's just, you know, the same feeling that's getting put through the economies and a number of cross assets is this reflation trade that's getting driven by higher commodity prices. I think, you know, we look at Brazil as a huge exporter of commodities, iron ore, although arguably they're behind the curve right now. They did have the Manly Vale shut dam incident, which was just horrendous. And they've also got widespread COVID situations where they're actually having to keep miners out from digging. But look, you know, this is only a temporary pause. I think this reflation trade, look, it's not going to go blowing out of the gates anytime soon. But I think if we move forward and with the just incredulous amounts of stimulus that are behind this economic reopening right now, looking at China, for example, is starting to really light up as far as purchasing managers index. I think this is where the push is going to come. This is where the commodity thrust is coming. And this is why we're starting to see those emerging markets that are net exporters of commodities start to flourish on a forward basis.
Okay. And well, I think, you know, with the whole coronavirus situation, it's really exposed the weaknesses, not only in emerging market economies, but in economies across the globe. And Alistair, we were talking previously, and it was, do you think that coronavirus is not only going to change kind of Brazil, the way Brazil's economy going further, but going forward, let me get that out, but also sort of change the whole Latin American region?
Yeah, absolutely. I think, you know, really economies in the region of Latin America, but also really the entire globe, are going to be look very, very different after this whole pandemic is really over. Latin nations, particularly obviously Brazil, sort of could look to implement quite a few different systems that might help them restructure towards some of the business failures that they've got going on. The loss of income is going to be hitting hardest on the members of the population that really need the income the most. So, we need to they need to be sort of having a look at how they might be able to support that, so they can get some of the capital to sort of flow from the old industries to the new ones. And of course, the biggest issue they have now, I suppose, would be more on that commodity side, just as Stephen was saying before. They are a massive commodity export. Iron ore is one of their big ones. And regardless of what they are actually exporting, because they are so commodity heavily driven, then it does really require them to start back up. But unfortunately, at this point in time, it seems that's probably not going to be an option for the short interim period. And after all of this is eventually over, which who knows how long that might actually be, I think we will be seeing a very different world for most of Latin America, certainly Brazil, and I imagine for the rest of the globe as well.
I totally agree. I think we're shifting away from supply chains toward cloud investment. I think that's going to be the new battleground for all the developing countries and emerging markets. It's going to be a computerized world for sure. It's going to be completely different as far as I can tell.
I mean, even sort of, developments into it just in the last sort of 6 or 7 months, you've now got medical services being conducted via mobile phone. So that whole app side and the tech side of life is really going to be increasing. And certainly there's been some serious advancements towards the AI side of things. So there are plenty of opportunities there at the moment when it comes to artificial intelligence and tech companies, I believe, especially moving forward beyond what we see right now.
Is it fair to say that emerging markets, obviously they're not as, say, as established as larger economies, they actually have a bit of an advantage to kind of adapt to the coronavirus situation and actually maybe benefit from it more in terms of, changing their economy to be more technology based, to be more, they can take advantage of this situation maybe better than larger economies that are slower to change?
I think there's really two sides to that equation. One side is, yes, they probably are in a better scenario because they haven't set up the infrastructure. They've got basically a blank slate. And should they get the investment, it allows them to set up. The downside or the other side of this coin is that one of the issues that comes with being an emerging market is that you don't get consistent stimulus coming in. You don't get consistent funds coming in or capital. So it makes it quite difficult for them to really continue that progress when it comes to these things. I mean, even if you were to look back at sort of 2007, 2008 during the GFC, all the stimulus that we sort of saw in the US actually overflowed into other markets. So we ended up seeing about $7 trillion worth of investment landing in some of these other emerging currency markets, but it was all inconsistently. So you get a period of booming growth followed by a very quick shortfall. Then it'd occur again, and the cycle kind of repeated itself. So if they're able to sort of put forward a stabilized way of actually introducing capital and attracting investors to want to go down that path of tech investment, then most certainly. If that wasn't an option, then it would be incredibly difficult for them to do so.
What's interesting in my part of the world, living in Asia, is how people have really embraced mobile technology. This has been the biggest thing in China, in my view, probably because they are, a lot of the cities are spread quite apart. So to do transactions, everything was done on mobile 2 years ago. Western economies haven't even caught up to that. We're looking at the kids in, say, Vietnam are totally embracing use of mobile phones. So they're doing complicated applications on, designing complicated applications for mobile phones. These are little simple things. These are not huge capital investment oriented things. These are small little projects that are making them a lot of money. So this could be a possible option. And I sort of tend to agree with what Celeste was mentioning about opportunities without even having to put a lot of capital in play.
And Stephen, just kind of keeping with China, obviously China is a big economy, but nonetheless, it's kind of considered as a rare emerging market currency. What's kind of going on with in China?
Well, well, we never know, to be honest with you, what the central banks are going to do. We never know what the policy is going to be at any time. I tend to watch the way the market's going. If the market's moving one way, I'm sure the national players are behind that move. And sure enough, we had a rally last week of 7%. We had another rally of 5%. And then we saw a lot of stimulus talk coming out of the markets again today. So I think what they're trying to do is hold back on the stimulus efforts to a large degree until the full reopening happens. I think throwing stimulus behind the economy when it's not open is sort of, well, wishy-washy. That's not really applying to anything. Really, what you want to do is get money in the hands of people that need it the most. And I think that's what China's trying to do, although, effectively getting, that policy transmission to the real economy has always been a struggle in China, because the banks take that money, reinvest it in high yielding assets rather than, lending it back out again. So we're trying to see how that's going to work out in the overall thing. Right now, there's a couple of positive things. It's too big to argue. Argument going on in China. This is why people are investing. Just the amount of the population, and just looking at the population throughout Asia, this is just the argument that's going on. I think the next wave of discussions that we were sort of hinting at earlier on, Alistair was mentioning, is this move away from supply chains more towards technology. I think we're looking at China, Japan, being on those cusps of really making some big inroads. We have the mega giants in the U.S. technology space, but I think the China and Japan's, those are really starting to catch up, and this is something that we have to keep an eye on. Look at the ownership in the markets right now. It's not really broad-based. High tech is really the flavor of the day, and I think this is why a lot of investors don't feel that much at risk, because these are sort of the stay-at-home kind of stocks. Even if the COVID goes up again, these internet companies are going to continue to do well. So there's something to be said about owning high tech, and there's something to be said about owning China. I think those two things mesh together. As a result, this favors the yuan, because the yuan could get strong, provided the PBOC is going to allow it. I mean, there's always that hidden hand that tends to manipulate the markets. If it gets too strong, it hurts export. So there's that fine balancing act that they're going to have to deal with also. But right now, things look quite positive.
That's good. Well, I think that's given a really nice kind of overview of the COVID-19 impact on emerging currencies. Obviously, there's a lot of currencies, and we're not going to be able to get to them all today. So I'd kind of like to step away a little bit from coronavirus, although I think it's during these times it's hard to completely discount the pandemic. But I actually want to look at the Turkish lira, which is a currency that was struggling before the pandemic, and since the onset of COVID-19, it has just it's been put even further under pressure. And it's actually at the moment currently the worst performing currency among developing currencies. And that fact was given to me by Alistair, actually. So thanks for that. But Haralambos, do you think that there's any hope for the lira?
The Turkish lira is not among the currencies I would bet on its recovery. At its latest gathering, the Central Bank of the Republic of Turkey held its policy steady for the first time in nearly a year, during which it cut its policy rate down to 8.24% from 24%, and signaled that it has stopped its easing cycle. What's more, last week inflation rose to 12.62 year over year, 12.62% year over year from 11.39%, which under normal circumstances would have raised speculation for the central bank to start considering hikes from here onwards. All this sounds positive for the Turkish lira. However, with Turkish President Tayyip Erdogan urging for single-digit rates, he's in favor of lower rates. We saw him firing the previous central bank chief. So with that in mind, I doubt that this bank could hike enough to stabilize inflation. And on top of that, with the coronavirus still spreading at a fast pace around the globe, a hiking strategy may not be that helpful for the Turkish economy, which is still suffering. Thus, so with that in mind, and also that real interest rates in Turkey are well into the negative territory, we adjust the interest rates in Turkey to inflation, we have negative interest rates well into the negative territory. And I doubt, so with that in mind, I doubt that the currency could attract much interest soon.
So it's not looking good, and it's likely to not look much better in the future. Is that the general gist of what you're saying there?
Yep.
And is that kind of the consensus among the panel?
It's one of those currencies I hate, absolutely hated trading, trying to collect nickels in front of a steamroller, so to speak, as what traders refer to the carry trade. But even trying to market make that currency was a nightmare in Asia, simply because there was such a huge demand from Japan for the carry trade. Given the amounts of political risk, every day we were worried about, on a Monday open where the currency was going to be. Those were some of the most wicked exoduses I've ever seen on a currency, just getting completely wiped out on a Monday morning. That's enough to keep me away from trading the Lira. Just having those memories of trying to manage risk when there was just a complete meltdown.
Post-traumatic stress.
Yes, 100%.
And Alistair, did you have some thoughts?
I do. However, I have just lost visual for everything. Are you able to hear me?
Yes, we can hear you, although you have frozen.
Yeah, I'm not sure what's happened there. I'm just trying to fix that, but that's okay. Yeah, look, I do have a number of thoughts when it comes to the Russian ruble. The Turkish lira. Looking back a little bit further than sort of 2020, there's a few different issues that have sort of happened for it. It's been in a particularly bad place to really weather the storm overall. We've seen unemployment at sort of 14%. We've seen dwindling foreign exchange reserves, growing unemployment. And there's been, really 2 years of it sort of, having negative data and macroeconomically being quite vulnerable before COVID. So now we've got tourism almost all but evaporating. We've seen the IMF sort of offer support, and the president there has basically rejected that as well. And at this point, the central bank has really been fighting like crazy to sort of keep the dollar versus the lira below that sort of 7 line, and which that's a significant barrier for it. But it feels like a losing battle on the Turkish side. And from there, we really are looking at potential rate cuts to happen, but it's been a constant state of the current president there putting in sort of his place or his understanding and idea of his own economics. And so usually you would see a central bank on its acting independently from its politicians. And that's not been the case, unfortunately. So because of that, we're now looking at an area where the economics of the country are entirely political instead of them being where you want them to actually be. And that's not a good place to actually be sitting in terms of development, especially from the value of the lira in general, and of course the volatility that comes with it. They've got the central bank net reserves are incredibly low. They've got banning of other banks and foreign investment occurring. So it's certainly not a situation I'd want to be in, and certainly not a currency that I'm interested in really trading myself at the moment.
All right, so I think that's pretty much a consensus. Avoid the lira at all costs. Don't trade the lira.
Absolutely.
Well, yeah, as we've all kind of mentioned, that it wasn't doing good before COVID, and it's definitely the situation hasn't helped. But Stephen, you keep mentioning carry trades, which EM currencies are used for quite a lot. Can you just kind of clarify what you mean by carry trades? And you're also saying to me previously about how kind of the Indian rupee, there's been an interesting situation going on from there. So if you could elaborate on that as well.
Yeah, carry trades are great. If you can find one that doesn't have a lot of underlying risk to it. Unfortunately, the biggest carries right now come with a lot of risk, and that's the problem. Back in the early 2000s, we had the Australian dollar, with a 7% carry. It was absolutely attractive with commodity prices going up, and those kind of G10 carry trades were just amazing opportunities for traders to get in. So they're trying to relive those memories through EMFX, and this can be good and bad. A couple of things that have to really play into consideration here. We need a real low level of volatility on currency markets in general. And that usually gets played through the U.S. interest rate curve. And we've got those conditions right now. Unfortunately, we've got this COVID-19 overhang that's weighing negatively on a number of these currencies because it just negatively impacts them from a fiscal perspective, because the governments are ready, coffers are ready, quite lean, and they have to spend more money on health and what have you. And also just probably infrastructure spending just to regenerate the economy. So these are quite negative. But basically what it is, you're taking a funding currency out, whether it's the euro, whether it's the US dollar. Those are generally the two prime currencies to fund with, and investing into a high yielding currency. Two currencies that have been really in favor over in Asia has been the Indonesian rupiah up until just this week, and the Indonesian rupee. The rupiah has suffered a little bit of a knockdown. It was very, very much in favor until late last week when the Bank of Indonesia introduced debt monetization. The thought here is they're going to start buying basically all sorts of government debt, and that's really going to get financed through the current account. And that's going to be quite negative. You're going to see inflation probably pick up as the money supply gradually increases. Now, timing that increase in money supply is always very difficult, but that weighs quite negatively for a currency. And when the currency is negative, you really don't want to be owning the currency regardless of what coupon is attached to it. Now the market's starting to look at the Indian rupee. The reason for that is really just the moving into a current account surplus, and just given the amount of capital inflows that are happening in the currency, and this is quite positive. So I think this will be continue to resonate quite well over the short term at least. But look, this thing is ultimately completely volatile. Once these currencies get too overbought, there's a tendency for the markets to flip very, very quickly on sudden minor impulses. So you have to be very, very careful when trading these high yielding currencies.
All right, and Alistair, are you still with us? You've been frozen for a while. All right, we might have lost him, but I guess we'll hope that he'll come back soon. But when we were kind of discussing topics on what would be really interesting to look at during this panel, both actually Stephen, you and Alistair, you both mentioned the Thai baht being a really interesting currency, which I found interesting because that's a kind of currency I guess not a lot of people know. It's not doesn't usually make the headlines. So kind of what is so interesting about the Thai baht, and what's been happening with it that's caught your attention?
Well,
Yeah, sure.
first of all, I live here, and this has been an interesting dynamic. And I've been following this currency for quite a while. I think if we look before COVID, it was a really good safe haven currency. When trade war was going higher simply because the travel sector was doing so well. Trade wars, people from China were still traveling, and this was quite positive. However, what we're seeing now as COVID came in, travel restrictions went up. Obviously, 20-25% of GDP in Thailand is made up of travel industry. It had a considerable knockdown, but it is recovering because, again, the corona divergence trade is actually working in its favor right now, and the fact that there's no virus here in Thailand to speak of. And there hasn't really been since the onset. So this is quite favorable. But there's a number of other nuances there. They've got a really strong capital account. The current account does really well. Gold is high, and there's a tendency when gold goes up that Thai people sell gold. And what happens then is the wholesalers of gold have to sell gold in the open market. They receive dollars and have to flip it back into Thai baht, and this makes it strong, much to the chagrin of the central bank. They don't want it strong, they want it weak. So there's a lot of dynamics at play with this little currency up here in Thailand. It's starting to catch a lot of interest again, and it'll be interesting to see where it goes over the next course of the next few weeks. I'm actually quite negative on it. I mean, I just don't understand what the appeal is to buy a currency when 25% of the GDP is not firing. But currency markets are crazy right now. I wouldn't. Nothing surprises me when I wake up in the morning to see a currency stronger or weaker these days.
And Alistair, are you there? I think we heard your voice. Is there anything you'd like to add on the Thai currency? I don't think he's here. All right. Well, then, yeah. So I wanted to also kind of look, because we're kind of ending or getting close to our Q&A kind of session now. So I would just like to take a look at kind of for future events that might have a big impact on the emerging market currencies. So I'd obviously like to look at the US dollar and the Mexican peso. Obviously in Mexico, they've got quite a lot of cases of COVID-19, but what's interesting for that currency is the upcoming US election. And I remember in 2016, the Mexican peso was kind of referred to as the Trump barometer. If Trump was doing well, the peso wasn't doing well. And if Trump was doing bad, then the peso was doing well. So maybe Harlem-Boss will direct this question to you. How do you think that currency might fare kind of in the lead up to the US election?
In my opinion, we will get the same pattern as in 2016. If anything that points to Trump being re-elected would be bad for the Mexican peso. Anything pointing otherwise would be good for the Mexican peso. Remember that during Trump's election campaign back in 2016, his verbal attacks against Mexico resulted in the peso being the third worst performing emerging market currency against the dollar that year. In 2016, it was the third worst performing currency. It fell nearly 21%. Yes, the US, Mexico, and Canada agreed to a new trade accord called the USMCA, which has replaced NAFTA. But with Trump's agenda, including further building of the wall at the Mexican border, I don't believe that Trump is the president of choice for Mexican pesos traders. So I believe that the pattern will be the same.
Well, I mean, they didn't get to building the wall, so maybe the Mexicans aren't as scared of Trump this time around. But it will definitely be interesting. And one thing for the US election, because we were talking about the ruble before, and obviously with the last election that was kind of plagued with sort of Russian intervention. Do we think that the ruble will be influenced or during the US election? Alistair, you're back, so I'll direct this question to you.
Yeah, I'm not quite sure what sort of happened on that. That was unfortunate on my end. All of a sudden, the screen just started blinking out and I didn't know what it was. I am back. So when it comes to the Russian ruble, I think there's a few different things to sort of consider really when it comes to the emerging markets that are available and the currencies that can be traded. I'm certainly more attracted to the Russian ruble and the Mexican peso versus the USD purely, because both, while, Russia and Mexico are classified as emerging markets, they're really on the border end of becoming sort of more advanced in my view, and more so the Russian side than the Mexican side. But nonetheless, they have certainly advanced areas of their economy, which you can sort of account on and rely on. And naturally, in addition to that, there's also the fact that they're both oil producing nations and as such have an observable correlation to the value of oil. So that gives us a lot more weight as to where we might want to go with that sort of thing. When it comes to the US side of things and their relationship between the lot, I mean, really at the moment with the US, you sort of have to take it day by day. There's nothing that really sort of sits or stands out that says, yes, this is where we're going to be in 6 months' time, purely because it's an ever-evolving situation at the moment for them.
Definitely. And that kind of is going to be our time for our discussion. So before we end it and go to the questions from our audience, obviously the panel today is, emerging market currencies. Can they be the saving grace of FX? So I'm going to ask this question to each of you to get your thoughts. So Harlem-Boss, we'll start with you. What is your take on that? Can emerging markets keep traders interested for longer and, keep interest and keep the FX markets trending?
In the short run, it depends how things with regards to the coronavirus will develop. I believe that if despite the reacceleration of cases, if the economies stay open, continue to recover, and we still see a trend in the equity world higher within, let's say, equity indices hitting new records. We saw Nasdaq hitting records recently. I believe that the emerging market currencies some emerging market currencies will perform relatively well, like the Indonesian rupiah, which where we have positive real interest rates there. And a point to make here is that if we take some major emerging market currencies against the dollar and we take the correlation with the S&P 500, let's say, to see whether how correlated we are with risk sentiment, we see that they are a really good bellwether of risk on trades. We have correlation of let's say if we take the Brazilian real, the Mexican peso, the Indian rupee, the Turkish lira, if we take all these well-known emerging market currencies, the correlation between those currencies and the S&P 500, it's more than 0.8, which is a very decent correlation. So if economies continue to recover, if we don't get any other lockdown measures, yes, those currencies will perform well. But in the, let's say, rare case of where we get lockdown measures, as the other panelists here said that, and I agree that it's unlikely to have another round of strict lockdown measures because the economies may not be able to weather that, and it will be disastrous. But let's say if in the case of that, if in case we have that happening, then emerging market currencies are likely to suffer because of another round of risk of trading. Investors will abound equities, commodity-linked currencies, risk-linked currencies, emerging market currencies, and seek shelter in safe havens like the traditional yen and nowadays the US dollar, which has been acting as a strong safe haven currency.
All right, and Stephen, what are your thoughts?
Not at all. They're just not widely tradable. There's just not a huge amount of bonds being bought in emerging markets, and that's the problem. A lot of bond funds just aren't allowed to buy them, and that's the problem. If they were allowed to buy them, there'd be more necessity for hedging. It's a speculative-driven market over the short term to a large degree. Outside of the natural form of hedging your bond positions forward. I get worried that lack of liquidity in the markets. I think most traders will back that view up. It's just, they're totally illiquid, and it doesn't make much sense really to overly trade them. Not to suggest that the carry trades should not be part of every portfolio, which they are. It's just, what proportion do you want to really allocate your time to trading? Really, for me, when it comes down to trading currency markets, it's all about the euro. Unless we get some movements on the euro, I just don't sense that currency markets are going to light up to any big degree over the next little while. We need some movements on the big G10s to really get the market driving forward. And as a matter of fact, look, if we had a weakening in the euro, this would be good for emerging market currencies. Anytime, a strengthening in the euro, this would be great for emerging market currencies. Anytime we can weaken the dollar index off, this is a good sign for emerging market currencies. So there is that knock-on effect of having a stronger euro in play.
And Alistair, what are your thoughts?
For me, the question in general, the saving grace implies that there's really a fundamental problem with FX markets as a whole already. So to me, when we're seeing that we've got the VIX index and a variety of other currencies, operating at what you would consider to be extreme volatility levels, and beyond that at times, it certainly isn't something that sort of sits with me quite well. I don't think it's made for a simpler way of trading emergency currency positions. If anything, the volatility has really been exacerbated for them and exaggerated beyond what it was under normal working conditions, which was known to be quite volatile already. And I have to agree with Stephen on the idea of, the stronger the euro, the better it's going to look for some of those emerging market currencies. Even just looking back this year in 2020, we've had the Wuhan outbreak, we've had the bottom of the barrel interest rates, we've had blame games operating between a multitude of nations, we've had free fall oil prices, hotspots in Latin America, defaulting businesses and banks, and I can just keep going on and on and on. And all of these things are going to affect, whilst they affect the major or the advanced economies of the world, they certainly have a ripple effect that hit on harder, because if you've got a problem in a advanced economy, then the investment that would usually come from the advanced economy into the emerging one gets harmed.
All right, well, so that ends our discussion. So let's jump on into the Q&A. So we've got a stream of questions coming in from our audience. So I will direct this one to Haralambos. What other upcoming market events besides COVID-19 should traders be looking out for specifically regarding emerging market currencies?
Besides any regional economic and political developments, I believe that traders of emerging market currencies, as I said before, should pay close attention to developments affecting the broader market sentiment. As I already know that carry trades are a bellwether of risk-on trades, so emerging market currencies against the dollar are very let's say emerging market currency pairs against the dollar are very correlated with the S&P 500. So it would be good to pay close attention to developments surrounding the broader market sentiment. Besides the COVID-19 situation, traders should also be aware of the resurgence of the US-China tensions, which could hamper any progress made so far with regards to trade, and may even jeopardize the already agreed phase 1 deal between the world's the world's two largest economies. So we saw the US accusing China for the coronavirus outbreak, approving sanctions on Chinese officials after China imposed a new security law on Hong Kong, which is believed to be restricting freedoms in Hong Kong. And so it remains to be seen whether these new frictions will result in troubles or further fears or with regards to the trade relationship between US and China.
All right, and Alistair, I'll direct this question to you. What contributes to the volatility and illiquidity of emerging markets?
Okay. So to me, I mean, economic policy in matured markets can really spill and overflow into emerging markets. I've said that a couple of times throughout the night. And the reality of the situation is that the lack of weight that you get behind an emerging markets in comparison to somewhere like the ECB or the Fed means that we have monetary policy measures such as quantitative easing can really cause sporadic inflows to occur in those emerging currencies. If we were to use the 2007 quantitative easing as an example, I spoke a little bit earlier about, nearly $7 trillion sort of overflowing into these emerging markets. And because there's not consistency in that sort of getting in there, it does cause extreme periods of volatility. The next factor that I think sits in my mind is, that really contributes is the reliance on commodity prices. Commodities tend to dominate that emerging market field. And as such, usually it results in some degree of correlation, just like we see between the Russian Ruble and oil prices. And that also brings in, usually you'll get a high period of inflation or during a booming period when they've got really good commodity prices and they've got good exports going on. But when you get the slowdown that follows that, it's usually quite nasty on the economy for an extended period of time. The Turkish lira is a perfect example of this because they did have a booming construction industry for a very brief period of time with higher inflation levels. And then not long after that, it sort of got chopped off at the knees, and that was really it for them. The third part is really to do with the government, and more specifically, the regulation and the controls that are usually mandated to help stabilize matured economies. They don't have the same effects in emerging markets because there's never seems to be a balance or that equilibrium that they can get just right. And it really leads to severe erratic fluctuations, harming their ability to remain competitive and, of course, harming their ability to actually attract further foreign investment.
And Stephen, I'll ask this next question to you, and it kind of really follows on from what Alistair was just saying. But what should traders be aware of when trading emerging market currencies?
First of all, is the lack of liquidity. That is the biggest problem. Is that the major banks don't provide ample liquidity. If you look at, say, top of book on a G10 currency, you're looking at the euro trading at around a point 0.1, 0.2 on 2 million on an NDF or not an emerging market currency could be considerably wider. The other fear is that when the market sells off viciously, so there's very, very little support to sell into that market. So, for instance, we can use the Turkish lira as an example. When there's a run on the Turkish lira, spreads can go from say 30 from 15 to 20 pips up to 1,000 pips. So that means crossing the spread is going to be mighty expensive, not to mention the number of stop losses that are going to get incurred. So when you're trading these currencies, you have to be very, very cognizant of the amounts of liquidity they're provided in the market. Constantly, coming from the trading side, we're very, very cognizant about this. And this is one of the biggest risks that we had with managing emerging market risk, let alone trading it. So if the market makers are worried about managing the risk, well, traders have to be worried about those market makers managing their risk. And I think that's what the biggest issue is as far as I'm concerned.
All right, and we've got another good question here, which I'll ask to each of you, and it says, what emerging currency appeals to you the most to trade right now? So Haralambos, I'll ask you first.
Okay, here I will have to go with the Russian ruble because of its correlation with oil prices and the fact that we have real rates in positive territory in Russia. So if we were to see better days ahead of us with regards to the coronavirus and we see oil demand increasing, then this should help the Russian ruble. Another currency I would like to closely monitor is this Indonesian currency because of its because we saw that currency covering almost all its COVID-related losses when the equity market rebounded. We saw this currency rebounding fairly well as well. I think it recovered around 12.4% against the US dollar. Real rates in Indonesia are positive as well. I think they are slightly more than 2%. And I'm curious to see whether further recovery in equity markets will lead to further recovery in this currency as well.
All right, and Stephen, what's your favorite currency at the moment?
Looking at the Asia basket, I'm more attracted towards the cyclicals, the currencies that'll light up as the activity data increases and stock or equity market flows come in. The two hot spots for me right now are the Korean won and the Chinese yuan. I think those are stellar bets. I think those will continue to improve, provided risk sentiment trades on an even keel. However, when it comes to foreign exchange, I think you have to be extremely nimble in this market, especially with the U.S. election risk coming in. The dollar is going to start voting for that. As a matter of fact, optionality around that November 20 date has already started to tick up. A lot of people looking to buy calls on the euro around that date. So the dollar is probably going to weaken as we gradually move over to that part. Whether you want to go all in on a currency moving into an election, just remember what happened to Trump's, how he got back in power. When he beat Hillary. So there's a lot of risk that's going to be involved with G10 currencies, let alone in emerging market currencies through the rest of the year.
And Alistair?
I actually have two or three that I like. The Russian ruble and the Mexican peso versus the USD, I've already spoken about briefly further on, with their sort of ties and the obvious relationship between oil prices, it does lead to a nice, easy sort of the volatile of volatiles. They are the more simpler ones to sort of keep an eye on, especially if you're thinking about them from more of a fundamental perspective. And the other one is actually the Thai baht. Compared to other emerging currencies in the region, Thailand has really got some strong economic fundamentals. Last year in 2019, yes, COVID has had a hit on them. Yes, they've got problems with tourism right now because you've got not people sort of traveling, but it has kind of operated as almost like an emerging safe haven for Asian specific currencies. And that's operating almost in a similar capacity to sort of gold, obviously not in the same sort of context, but similar sort of mindset. And because of that, there's a couple of other little things that sort of add to it being something that's a little bit more attractive, especially for someone who might be interested, who's been traditionally trading majors, and that tends to be that it's less prone to the US-China relations that have sort of gone on, regardless of what the catalyst is in that news event. You tend to find that it's a little bit simpler. And those are really the more influencing factors. You do also find that you can easily keep an eye on what their inflation rate is doing and what their current account is doing, and naturally what the policy, whether it be monetary or fiscal, around both of those. So it does make one that's kind of neatly packaged and quite simple to keep an eye on what's going on without getting overcomplicated. And same thing with the ruble and the Mexican pesos. Because of that, inherent a correlation between oil and the value of their currencies, that keeps it simpler as well. And I like keeping things simple. It makes it much easier on everyone else.
It definitely does. And Alistair, I'm glad you got to talk about the Thai baht, because you missed out on it before when Stephen was talking about it.
I was actually quite negative on it though, Alistair, so I'm glad you sort of countered me back. It's okay.
No, that's fine. That's fine. I didn't have to hear that before, so it was okay. No, I honestly, I have no idea what happened to my computer. Everything just did not want to play ball. So thank you for covering on that.
No, but that's what makes trading interesting, is the fact that, we all have different, we're all picking up on different signals. And this is what makes the world go round. And this is really, being in the market for so long, is that you have to respect other people's opinions. And, what I'm learning from this discussion is that I don't know a lot about the Russian ruble. And I have to thank you guys for updating me on all this stuff. It's a currency that I don't follow. So it's very much appreciated, this type of discussion.
No, you're absolutely welcome. I'm glad to have been a part of it. In terms of the Thai baht, it's one of those ones that I don't trade very often. And when it comes to FX, I'm much like you, Stephen. I don't like to put a huge amount of risk into them. And I certainly don't like to overweigh myself or over leverage it either. So even saying, yes, I like the Thai baht, I'm still going to prefer to be trading other currencies like majors, because they are much cheaper. You get more liquidity, and of course you get better commission structures for them as well.
Sure.
Perfect. Well, that ends our time, unfortunately. I feel like we could talk about emerging markets all day, but but I think Zoom will probably kick us out soon. So yeah, I'm glad that, Alistair, I'm glad you came back, and everyone else. Thank you so much for being here for the conversation, and for giving our audience and myself a really enlightening discussion. Thanks very much.
No problem. Thank you for having us.
Not a problem. And to our audience at home, thank you so much for joining our latest episode as part of FMTV. We'll be doing another webinar next week, so be sure to come back to Finance Magnates to see all of the details on that. And until next time, we hope you have a lovely day. And again, thank you, everyone, and we'll see you next time.
Thank you.
Thank you very much.
Thanks, Celeste. See you. Bye-bye.
Bye.
Bye for now.
Bye.